because my next guest is not only going to help you to talk about and educate you on the world of investing from a like a down payment perspective. It's very unique what him and his firm do. In fact, they've been helping our REC insiders for the last half decade now, very closely works with my team, and he helps our REC insiders invest those registered funds. It's none other than Mr. Lawrence Raponi. How you doing, brother?
I'm good, man. It's good to see you, Jazz.
It's always good to see you.
Another day, another webcast,
that's
right?
it, man. Just another piece of content. The only difference here is that we went on for 5 hours, or we're almost at our 5 hours. And
nice.
Guys, I appreciate you so much, because not only did you stick around for the starting line, the first leg, we're obviously coming around the corner. I always like to think that the thoroughbreds, the horse races, the horses that win the race, they always come in at the end. You know, you've been watching those horse races before, and you're like, oh, he's coming around the corner. We're coming around that last bend. And obviously we have two people left here, and Lawrence being one of them. Lawrence, brother, what you guys do at Equiton is awesome. You know, when you got a guy like Darren Voros mentioning your name, who's out there a lot, and he's mentioning your company, and he knows that, like, that's a pretty big, referral that you're getting, a pretty big introduction, right? Let alone from us, because we make sure that our relationships with our service providers are very strong. Mm-hmm. Talk about the world of Equiton, and then let's speak about investing your registered funds into real estate.
Yeah, of course. Look, Darren's vote of confidence, and Jazz, your vote of confidence from all the background guys at REC means the world to us. And you already know we've been partners for years and years now, with a great mutually beneficial relationship. So Equiton, who are we? What do we do? Equiton's a real estate investment firm that allows investors to invest capital into real estate completely passively, which means you don't need that massive down payment to throw down on an acquisition, which in the GTA can be astronomical. You don't need to go to the bank and get financing at 6.5% today, sometimes even higher, and the stress test qualifications upwards around 7.5%. And best of all, and this is the feedback I get from my clients, you don't have to be a landlord. You're not managing these properties on the day-to-day. And everyone sees news headlines of the strong performance of real estate as an investable asset class, and of course, that is true. But what people don't take into consideration is that when you go out and buy that first property, you're running your own business, right? You're vetting your tenants for credit quality, you're watching your P&L, you're watching your cash flow, you're responsible for fixing the leaky dishwasher. All this stuff falls on you, the business owner, right? And so a company like Equiton will come in and allow investors to participate in physical real estate assets the exact same way, but on a completely passive basis, where you're partnering with Equiton as the asset manager, you're leaving it to the professionals at our firm to do this for you, and you're profiting in not only the cash flow from these buildings, but also the appreciation.
Well, you said cash flow of these buildings. What is that? Like, what buildings? What are we talking? Like, what? So you take up my investment, okay, of $25,000. And I think you have something still, and if I overstep my boundaries, please let me know. Do you still have something with like $5,000 investment or something?
Yes, we do. Okay. We'll always keep it at $5,000.
Darren said it good too earlier. He was like, one of the biggest mistakes he sees investors make is that they think that they need a lot of capital. There's something that he has, which is like 25 grand, I believe. I could be wrong. He's giving me the thumbs up out, from backstage there. But you don't need a lot of money. In fact, you can invest as little as $5,000 into an investment, right? Like, that's pretty cool.
We've democratized the world of real estate investing, right? We've eliminated as many of the major hurdles to get involved in an asset like class like this as we possibly can. So at Equiton, we're a simple company. We have 3 different investments, but really they're broken into 2 categories, right? On the one side, we have funds, real estate funds. On the other side, we have developments. And developments, they're getting a lot of interest and traction from folks now just because of the sky-high returns, but the funds is usually where I start with my education with my clients first. With a fund, you're investing directly into an entire portfolio of real estate assets, right? So you're getting diversified exposure. And for us, diversification means lower risk, right? Because if one of our buildings' vacancy rate shoots up or one pipe bursts in one building, we're not really affected on the whole because our portfolio consists of 32 buildings. The second thing to know about the funds, not only are you diversified, Jazz, but you're going to get cash flow. Both of our funds, and we have 2 of them, they're cash flow machines. That's really what they do. They're paying generally between, I'd say, 5.8 and 6% on to investors.
And how is that paid out? Like,
it's paid out on the 15th of every month. Okay. Again, we want it to be the same as physical real estate ownership.
Pretty cool.
You buy a condo, you rent it out, your tenants are going to pay you monthly. We're going to pay you monthly the exact same way.
Okay.
Right? And the third thing to know is that these investments are liquid. You can buy them today, you can sell them in 6 months, a year, 2 years. Now, there are some restrictions on when you can sell them, but far, far more liquid than a physical piece of real estate, right? Much, much easier to move in and out of than a $2 million duplex or $2 million triplex.
And I just want to make sure I heard you properly. You said the returns on that would be somewhere around 6 to 8%?
The cash flow.
The cash flow, I apologize.
6%.
What's the actual
But
annualized
the actual return can be anywhere as low as 8%, which
Okay.
isn't even that low, but upwards of 16%.
Perfect.
So,
and one of the main reasons I wanted to have you on is because majority of people still, we're all in this world, right? Me, you, Simos, Darren, Chris, Slidem, Krista Souza, Patrick Francie. We know that you can invest registered funds into real estate. Majority of my guys and gals still don't know that. And I think that's very important because personally, I advise my clients and myself not to invest cash into a type of investment like Equiton. I personally think that you should invest it into an income property. That's just my thoughts, and we can have healthy debates around it. There's nothing wrong with that. And the reason is because you can see returns as high as 28 to 45% year over year. And so why not take that cash and invest it into an income property? Where I love what you guys do, and so many of my clients have, but majority of them haven't gotten in touch with you guys yet. And I'll let you know how to get in touch with these guys right when we speak with Tyler, because there should be a process, and to make sure it's even right. And then this way you don't waste your time, you don't waste Equiton's time, and I'll talk to you about that when I speak to Tyler. I like the fact that you can invest your registered funds where you're probably seeing anywhere from 2 to maybe 4.5% returns through a mutual fund or a GIC, right? You might even see as high as 5. I haven't come across that recently, but call it around 2.5 to 4%. So if you can now invest that money, again, not that smart, but I do know basic math, that if I can see 8.5 to 16% return and still keep it in my registered fund and not have it taxed, not pay a withholding tax. It stays in my RRSP.
And you're invested in an asset class you know and love. It's consistent and stable. And that's the other thing that people don't really take into account. They go, oh, your fund pays 9%, 10%, or 8%. I might be able to do better if I take a certain level of risk in the stock market. And I go, sure, you know what? If you want to swing for the fences and try and double your money overnight, there are investment vehicles out there to do it. But I have not come across an investment, Jazz, that can do on average 10% annually, literally never drops in value.
I think
it has never dropped in value.
If you look at the S&P, which is like the accumulation of some of the best stocks in the world, the rate of return over like a 10-year period is like 6%.
Over time, it's approximately 6. Sometimes it's 8. It depends which time horizon you grab.
6 to 8%.
But sometimes you'll do 15, and sometimes you'll lose 25.
Right. Well, I'm talking about the average, right?
Problem.
Exactly.
It's the volatility.
Right. And so here, I still want to walk people through that process with their registered fund. So if I have a registered fund with the let's call it the Red Bank, that's where my money's sitting, okay? Because nobody sponsored us yet from the banking, so I just won't say their name. It's the Red Bank. And so if I have my money in an RSP with the Red Bank, how the heck do I get it to you guys?
It's a process that is handled completely internally by myself personally for my clients or the folks at Equiton. We do everything for the client. The idea here is just to make it as simple as possible. So we're going to put in a transfer request. We're going to move their capital from whichever TFSA or RSP or LIRA it's currently sitting in, doing nothing, and we'll move it over to a trustee bank that allows for these types of unique private investments to be held within them. So I think beyond that, it gets a little complicated just for our short time and conversation. But if you guys are interested, if your viewers are interested, book an educational call with our team and we can walk you through it in detail. But the point is, you don't have to do anything.
Right.
We do everything for you. We do all the paperwork. It's a very, very simple client experience. And that's what we're going for, simplicity.
Now, when you do that initial consultation with them, what kind of questions are you asking them? And just so my guys and gals know what to be prepared for.
I repeat myself so many times on my client calls when I I start them, the first thing I say is, this is meant to be educational for you.
Yeah.
But I'm going to be learning as much about you today as you're going to be learning about who we are and what we do. And I start by going through discovery, right? Who are you? What are your investment goals? How old are you? Are you married? Do you have children, right? What are you trying to accomplish here? Not only today, but 5 years from today, 10 years from today. And then we work backwards. We go, okay, based on the kind of person you are, this might be the best way to proceed. Right? And sometimes after that short initial conversation, we come to the same conclusion, which is maybe this doesn't make sense for you, right? If you need your money back in a year and a half, I'm not going to put you in a 6-year development project that gives 120% returns, because as juicy as that is, it's nonsensical.
Right. Now, are you regulate, like here from a real estate perspective, I'm regulated in the province. I can only sell real estate in Ontario through the Real Estate Council of Ontario. What's like your guys' whole world? Like, I know nothing really about it other than the basic stuff, because I've had some conversations with you. Because my concern would be somebody would think like, is this like a fly by the night thing? Is this like are you selling it in the alley?
Yeah,
like
these
I
questions,
really, it's important.
So
Good,
often. A common misconception, because we're a privately held firm, Jazz.
Yes.
People think that because we're not a publicly traded stock that we exist in the wild, wild west where everything goes. There's no disclosures. There's no transparency. They think we're like a black box hedge fund. But the reality is that couldn't be further from the truth. We're regulated at the firm level. So Equiton Capital is a licensed exempt market dealer. We call them an EMD, and there's a lot of requirements that they're beholden to on that level. But on an individual level, Jazz, I'm licensed, and I renew that license annually. I'm what they call a dealing representative. And so I have a fiduciary responsibility to my clients. My name goes on every single deal or every single investment I do for a client to make sure that it's suitable. So their best interest is always being represented, yes, at the firm level, but also at the individual level as well.
So my team, when we sit down and speak to our insiders and do our consultation, we find out what they're looking to do, like similar to what you guys do. In fact, a lot of our consultation is actually stolen from your kind of industry, because you guys do what's a KYC, so like know your client. Right. We just came up with a new name and called it a real estate action plan. We weren't that creative that day. And so what we do is find out what they might be wanting to accomplish, and then we speak about certain types of investments. So there's the pre-con, the land development, there's investing your RSPs, there's income properties, there's multiplexes. But we always touch on is that there's benefits to all of them, but there's always things that you want to consider with all of them. Meaning that if someone says to you that there's no risks involved when it comes to like real estate, and even though we're talking about registered funds, there's still risks involved with.
Someone tell you there's no risks? I didn't mean to cut you off. You
run away.
The opposite direction.
No, buddy, it's okay to cut me off. It's good, man. I cut everybody off, so I'm used to it. But you got to run the other way.
Yeah,
you know what I mean?
Well, they're not being forthright with you. 100%. Why would you want to do business with
So let's do the exact opposite of that, and let's actually give people what some of those risks are, those things that they need to consider when getting involved with you guys.
Because when we raise capital from a client, when I take in $20,000 for an investment, I'm going to use that capital towards physical brick and mortar real estate, Jazz. The same risks that exist in a physical real estate investment exist for us. We're not immune from interest rate moves. We're not immune from demographic shifts or immigration policy shifts or real wage growth, right? Rent. All of these things factor into the types of risks that can move a market either upwards or downwards for us. So I don't think it's too different from any physical real estate. The biggest thing for me is time commitment, right? Specifically on those developments, right? Because once you make a development investment, you can't decide 2, 3, 4 months in that you want out, right? These are fully illiquid investments. And so I'm having a very, very lengthy conversation about timeline, the potential for delay, which if anyone's bought a pre-construction condo knows that it can happen, right? And so we're having that stance. Really, it's the time delay that's the biggest risk.
Now, in overall, like you're obviously having a lot of conversations with a lot of potential investors, people who actually take action and invest. When they start to talk to you about the Ontario real estate market, what's your thoughts on it? Like what feedback are you giving them? Because you guys also are very factual based. Like before you make an investment into a multiplex and you were in the province, I mean, you guys obviously have a massive research team that are looking at a lot of numbers. What is the data telling you in kind of today's environment that could make that still spells making an investment in real estate safe?
Yeah, we are a data-driven firm, and we are always looking at that data. But the data is now maybe more than ever shifting at a pretty fast rate. The biggest things for us that we're paying attention to are upcoming potential for recession, so a drop in domestic output, but also we're looking at migration trends, which have been a very, very bullish indicator for us, so a positive indicator.
Okay.
Most
Now, when you say
recently-
migration, like dive into that for me.
We all know that the Trudeau government has mandated to let in approximately 500,000 new immigrants into this country over the past 3 years and going into the subsequent 3 years. Last year alone, they doubled that. They did over 1 million. Now, I'm reading news articles just this week of Stats Canada misreporting that number by about 1 million. That is absolutely massive. And it's very bullish for us, particularly with our rental strategy, because when you're a new immigrant to a country, you're not buying a $3 million house more often than not, right? You're coming here, maybe you're a permanent resident or a student, you're going to be renting. And so that's very, very bullish for the majority of our strategies.
Right.
So that's the really big needle mover for us now. We're paying very close attention to urban centers, particularly the GTA, but also secondary markets. For instance, the Golden Triangle, Guelph, Kitchener, Waterloo, we're looking very closely there to watch these types of trends. But overall, we are extremely bullish on real estate, particularly rental real estate. Rental rates have not dropped. Even though inflation has come down marginally, they have stayed very sticky. And the bottom line, in terms of reasons why, supply and demand discrepancies. There isn't enough housing for these people.
It's funny, right?
In.
Because I think almost every person that spoke today, and I know we sounded like a broken record, it all comes down to the supply and demand.
Well, we're all reading the same data. And look, real estate can be complicated, but I think it's actually quite easy. Right? The data is out there. Everyone needs a place to live. Real estate, particularly residential real estate, by its nature, is a more defensive investment. And just things don't change that quickly over time.
What do you mean by defensive nature? Like, I want you to...
Yeah, so we like residential real estate, that particular strategy, because it is defensive. What does it mean? People need two things, ultimately, right? They need to eat, and they need a roof over their heads. So depending on the type of real estate you buy, as long as you're not going super high-end luxury, this is very, we'll call it sticky, right? In terms of people are always going to need to live there. If you're not charging absorbently high rent today, the odds of your tenant turning over is actually quite low, because it probably means they're not going to get a better price elsewhere. And so you're going to generate better returns in markets that maybe are moving sideways or potentially moving downward in a way that you're not going to see in other asset classes.
Now, have you seen like your performance be affected significantly because of this high rate environment that we're in?
Yeah, every single client I do an educational call with has a question about either inflation or interest rates. And those two things are exorbitantly connected. But rule of thumb, and everyone knows this, there's a negative correlation between real estate asset values and interest rates. Now, the reality is the correlation is a lot more complicated than I think some of the people let on. At Equiton, we're rather unique because we have been underwriting properties with a 10-year fixed mortgage since we started our company 7.5 years ago. Our weighted average interest rate, Jazz, across our portfolio, 3.07%. Wow. That's our weighted average interest rate. And the weighted average maturity is just over 7 years.
Okay.
So I have that 3.07 for at least a half decade, if not more. And they're
then,
very, very well positioned.
Right. And now you're obviously, when you're looking at properties now, though, are you still looking at kind of a 10-year? Like, what are you guys looking at now when you're trying to buy?
We're relaxing
property?
our mandate on the 10-year fixed, right?
Okay.
Our shlick at Equiton is we see what others don't. Right?
Okay.
That's the first slogan you're going to see when you go to equiton.com, and it sounds like a cliche statement, but it's true. Right? So whatever strategy we may have used in a lower interest rate environment may not be the strategy we're going to use in a high interest rate environment.
Okay.
Right?
So now, I want everyone to know that he did, my boy here, Lawrence, mention the website, which is equiton.com. But I actually believe that before you even go to the site or get a hold of Lawrence or anybody at the team, I actually think you should be sitting down with our director of real estate investment coaching, which is my next guest that I'm going to be bringing on. And we're going to be sitting and talking about what we actually do through a real estate action plan. But before I bring him on, any parting words for investors in today's landscape, brother?
Yeah, I'll close by saying this. Look, I'm a direct real estate investor myself. I own my own rental properties. I absolutely love them. A company like Equiton and a passive investment like Equiton's isn't meant to supplant that. It's meant to complement it, right? It's another tool in the investor's toolbox to achieve whatever financial goals you may have. And I think that's where I'd like to leave it.
My brother, thank you so much. I really appreciate you. I know
Always a
that
pleasure,
we've
Jess.
done a lot of stuff together, but every time we call you, you come out. And so thank you for that.